Well, welcome back, ladies and gentlemen, to Chalice Brand's channel, an EBITDA positive, financially disciplined, and vertically integrated cannabis company. Joining us today is the executive chair, John. Welcome back, sir.
Thanks, sir.
Such a pleasure to have you.
We're enjoying this. Thank you for the opportunity to keep talking about our story.
Yeah, so we got lots to dive into with the current macro events going on in this economy globally. But before we kind of talk more about that, I want to dive deeper down because Chalice Brand pre-announced 61% year over year fourth quarter growth and record yearly revenue. Can you kind of just break this down and offer any insights?
Well, I think there's two parts of our growth that people I've seen some questions asked, and I think it's worth highlighting. The organic growth that we would have had with our existing footprint, and then if you look at it, this time last year we had 7 stores under that we owned. We added the homegrown stores during 2021. We announced the cannabis transaction, and so those two themselves are different. One we actually own full economics to, which being homegrown. The other being cannabis, where until the regulators approve the full transfer, all we're getting is management fee revenue. So while we control the store, that isn't our economic benefit yet. So organically, we grew as Chalice free homegrown transaction. But I think one of the things investors need to realize is that whatever state you happen to be in, same store on store growth are going to be like most retail companies. You're not going to take $1 million store and turn it into a $5 million store next year. That's just not going to happen. So as long as you're getting, and things that we look for are, per ticket sales, traffic, growing the store, same store economics, which we are doing. Then to keep growing, that's why our consolidation strategy makes sense. Homegrown, and it's twofold. We benefited from, I think the transaction closed towards the end of May. So basically 7 months of homegrown revenue contribution. We picked that up. On top of that, when we purchased homegrown, they had maybe 2 or 3% of Chalice products on their shelves. By the end of the year, we're up to almost 30%. So we've done a switching out of product line, which then starts showing the vertical margin contribution, which is why the seed to store model will work and it will continue to work, and that's what we'll continue to do. So 2021 was a combination of continuing to grow our same stores plus the contributions of the new acquisitions, and that's going to be the same thing that we should look forward to in 2022. 2022 will have the benefit of the full year of homegrown, and whenever we get through the OLCC's approval, we'll get to pick up the cannabis transaction.
Yeah, that vertical integration gives you quite a bit of control over many metrics, right? But on that note, when we come back, what we're going to do is we're going to update some of the financials when they do fully get released. So consider subscribing for that. But I want to ask you, obviously, in 2022 here with the mix of the macroeconomics, just seeing a lot of these stocks sell off, you guys in a comparable market to some of your competitors there, it looks to be setting up for an interesting kind of value play. Do you have any just insights on the sector?
Well, I can tell you that if you look at when we closed the last financing, that was in November, we closed it at 75 cents a share. All we've done is get stronger since then, and stock today is trading at 39 cents Canadian. I think if you ever wanted to point to reasons why there's an undervalued story, this is it. I've seen competitors put out numbers that are half the size of our revenue, and they still trade above us in terms of market cap. So I think there's a complete disconnect. The only thing that I can think of is people have a misunderstanding of our debt position. And as a release, I think a week ago we put out a year in review that summarized, and I strongly encourage viewers to go back and look at that, because I think it really does highlight the positive moves the company's made in the past 12 months. And one of the things we stated in that release is that we have cash on hand to manage our debt obligations. And so I think people need to remember that we have shown we have been ahead of dealing with our debt obligations historically. And if nothing else, if past performance is an indication of where we'll go, assume that we'll govern ourselves in the same manner that we will manage our cash flow requirements and come out on the other side even stronger than we are. We're all hoping for deregulation to happen in April. So I'm hoping that we start seeing the benefit of that. There is no reason why the stock shouldn't be $1 today based on fundamentals. Pick any comparative model you want and apply the multiples. I think we would justify being in that range in a heartbeat.
On that note, John, I appreciate these insights today. Thanks so much for coming out.
Thank you. We'll see you next time.
Always a pleasure. On that note, folks, I pass the question off to you. As always, let us know what you think in that comment section below. And again, consider subscribing, because as this news comes down the wire, we're going to update you here. But stay cool, stay awesome. And as always, I look forward to catching you in the next one.